Bullish rectangle pattern is a technical analysis chart pattern that is formed when the price of an asset trades within a specific range for a period of time, after which it breaks out to the upside. This pattern is characterized by two parallel trend lines, with the upper trend line acting as resistance and the lower trend line acting as support. Trading this pattern can be profitable if done correctly. In this video, we will discuss how to trade the bullish rectangle pattern. Identifying the bullish rectangle pattern. The bullish rectangle pattern is identified by two parallel trend lines. The upper trend line acts as resistance, while the lower trend line acts as support. The price of the asset will typically trade within this range for a period of time, and then it will break out to the upside. The length of time that the asset trades within the range can vary, but it is usually a few weeks. Trading the bullish rectangle pattern. Once you have identified the bullish rectangle pattern, there are a few steps to follow when trading it. Step 1, wait for the breakout. The first step is to wait for the breakout. The breakout occurs when the price of the asset breaks above the upper trend line, which is the resistance level. This is a bullish signal, indicating that the buyers are in control, and the price is likely to continue to rise. Step 2, set your entry point. Once the breakout occurs, you need to set your entry point. You can set your entry point at the breakout point or wait for a pullback to the support level before entering the trade. If you choose to wait for a pullback, make sure that the price does not break below the support level, as this would invalidate the pattern. Step 3, set your stop loss. Setting a stop loss is crucial in trading the bullish rectangle pattern. You can set your stop loss just below the support level or at a point where the pattern would be invalidated. This will help you limit your losses in case the price moves against you. Step 4, set your take profit. The take profit level should be set at a point where the price is likely to encounter resistance. You can identify this level by looking at previous highs or by using technical indicators such as Fibonacci retracement levels. Step 5, manage the trade. Once you have entered the trade, you need to manage it carefully. Keep an eye on the price and adjust your stop loss and take profit levels accordingly. You can also consider trailing your stop loss to lock in profits as the price continues to rise. Here are some additional tips to help you trade the bullish rectangle pattern. Look for confirmation. Always wait for confirmation of the breakout before entering a trade. This can be in the form of a strong bullish candlestick pattern or a surge in trading volume. Pay attention to the time frame. The bullish rectangle pattern is most effective when traded on longer time frames such as daily or weekly charts. This will help you filter out the noise and focus on the larger trend. Use additional technical indicators. You can use additional technical indicators such as moving averages or oscillators to confirm the strength of the bullish rectangle pattern. Avoid trading during low liquidity periods. Low liquidity periods, such as holidays or after-hours trading, can lead to increased volatility and false breakouts. Avoid trading during these periods if possible. Practice proper risk management. Always use proper risk management techniques such as setting stop-loss orders and limiting your position size. This will help you minimize losses in case the trade doesn't go as planned. Conclusion: trading the bullish rectangle pattern can be profitable if done correctly. However, it is important to remember that no trading strategy is foolproof, and losses can occur. It is important to have a sound risk management strategy in place and to only trade with money that you can afford to lose. With the right approach, the bullish rectangle pattern can be a useful tool for traders looking to profit from market trends.